Good morning, good afternoon, good evening, and good night for those of you who are joining in the middle of the night, which is the case of one of our speakers, with many thanks. I'm Nicolas Véron. It's my honor on behalf of the Peterson Institute for International Economics to introduce this new session of the Financial Statement series at the Peterson Institute. Today we are talking about bank capital regulation and climate change. And we have two, if I can use that expression, world-class capital nerds for this topic. One of them is joining us from New Zealand, from Wellington, Martien Lubberink. So it looks from his background like he's in the library, but actually it's the middle of the night. So many thanks, Martien, for that. Martien studied at the University of Groningen in the Netherlands, where he got his master's in economics in 1992, his PhD in economics in 2000. He was an assistant professor of accounting at Maastricht universities and at Lancaster University Management School. In 2008, he joined the Central Bank of the Netherlands, de Nederlandse Bank, which I never pronounce well. Where he stayed for 5 years, and he was in charge of the negotiation and implementation of Basel III, of the forced capital requirements directives, the interaction with international financial reporting standards for the capital nerds, which is very much our community today. This was, of course, the time when Nout Wellink, the governor of the Central Bank of the Netherlands, was chairman of the Basel Committee. It was when Basel III was being negotiated, so it was the most active period in that world, in a way, ever. Martien left the Dutch Central Bank and the Netherlands in 2013, and since then has been at the Victoria University of Wellington, New Zealand, also known as Te Herenga Waka, in Maori, where he is an associate professor of accounting and capital. He also does a lot of consulting, of participation in public debates about these capital issues on social media. He's a member of the Basel Committee Task Force on Evaluation, and more generally, I would say, bank capital guru, if there is one on this planet. Sylvie Matherat studied at Sciences Po and at Paris Panthéon-Assas University, where she got her Master's of Political Science and Government in 1985. She worked then at the Banking Commission of France, which is essentially hosted by the central bank in the late 80s. In 91, she joined the private sector, at that time Paribas, which was not yet BNP Paribas, where she worked in structural finance. And in 1996, she went back to the Banking Commission, later to the Bank of France, where in 2007, she became the director for financial stability. She was a member of those same organizations I partly already mentioned, the Basel Committee, but also the Committee on the Global Financial System in Basel, the Committee on Payments and Settlement Systems, which is now the Committee on Payments and Market Infrastructures, the Bank Supervisory Committee of the European Central Bank, and I'm leaving aside many other committees. Basically, she's done all of them, including at the Financial Stability Board. In 2014, Sylvie joined Deutsche Bank, where she was in charge of global regulatory affairs and chief regulatory officer and member of the management board, the Vorstand, starting in 2015. She stayed there in 2019, and I don't have to insist on the fact that this was a momentous time for Deutsche Bank, and when Sylvie's job was one of the most high-profile jobs you can imagine in global banking. Since then, Sylvie has participated in a number of organizations and initiatives. She was a member of the High-Level Forum and Capital Markets Union immediately after Deutsche Bank, or maybe at the end of her tenure there. She was a non-executive director. She is a non-executive director in the bank that has been called My Money Bank and is now back under the brand of Crédit Commercial de France in Paris. She's the senior advisor at Mazars, an accounting firm. She's a member of the International Advisory Board of Edmond de Rothschild, and she's also soon to be board member in another big banking organization, as is expected, but this is not yet official. Non-executive board member, to be clear. So, Sylvie, you're independent and speaking on behalf of yourself, not of any of those organizations. With that, Martien, the floor is yours.
Hey, thank you very much for inviting me, Nicolas. It's a joy to be here on this panel. I was just watching a movie, and then I realized it's getting towards 3 o'clock in the morning. I don't do this regularly, and I'll probably have a bit of a hangover tomorrow. Let's see. So I'm going to share my screen if that's okay with you, and please let me know if that works. Is that all right?
Yes, it works.
Yeah, does it work?
Yes, it's perfect.
Okay, bon, off we go. So what I'm going to do is to take you through some prudential issues with respect to climate change which have evolved over the last couple of, say, year, two. But before I start, two things I have to explain a bit for the audience, because not everybody is probably aware of the things that are going on within prudential banking supervision. And I'm going to explain these three pillars, which I call the good, the bad, and the ugly, because I will refer to them quite often in this brief presentation. So there's three pillars basically that structure the supervisory approach of the Basel Committee. The first is pillar 1, and then you have pillar 2 and pillar 3. So pillar 1 is where the rubber meets the road, where that determines the capital requirements, like the 8% or 10.5% requirement of capital vis-a-vis risk-weighted assets. These capital requirements are kind of hardwired into the Basel framework, and banks have to abide by them, else they lose their banking license. So it's quite important to stick to those. They're visible and transparent, and everybody knows them. And banks tend to not like them very much, because if you increase pillar 1 requirements, then banks will have to issue more capital, which is costly. On top of that, and that is not always known, I think in many countries and also amongst academics, it's kind of a blind spot. There is the pillar 2 capital requirements, which are add-ons that bank regulators can impose on banks to hold more capital for risks that are not covered by pillar 1. So these are things like legal risk and legal risk and concentration risk and reputation risk and so forth. Now, as a non-traditional risk, all the risks that have to do with climate are probably very nicely, or could fit in the pillar 2 approach very much. And that's what we will see in the slides ahead, is that many of the action with respect to prudential regulation of capital happens in the pillar 2 space. These are not always transparent, and so investors do not always know why a bank holds more capital. Sometimes it's because the bank wants to hold it by itself, to have large headroom, to have more additional capital. Sometimes it's imposed by the supervisor. Europe is pretty transparent about pillar 2, but other countries like Australia, pillar 2 capital is kind of opaque and vague and not to be known by investors. And then the good part of regulation here, which I think is kind of innocuous or kind of good, is the disclosures under pillar 3. And so banks have to disclose additional information under the pillar 3 framework, which is then based on the idea of market discipline. When banks disclose more under pillar 3, then investors would respond to that, and it's kind of a back and forth between investors and banks to discipline the banks a bit better. Again, here you see a lot of actions going on in the pillar 3 space. Second thing that I want to explain very briefly is the Basel Committee of Banking Supervision membership. It's not it's not like a small committee. It's about 45 voting members. And what I find striking is that most of the action happens, or most of the power resides in Europe. If you look at the map here, there's a lot of spots in Europe that cover the membership. And so Europe has a big presence within the Basel Committee, and also Basel is in Europe and so forth. So you can see that Europe is pretty much visible at the table, and when it comes to voting. Also, the ECB is there together with the supervision branch of the ECB. They have, I think, voting rights as well. And then, there's the EBA and the European Commission that also are observers. So countries like Portugal and Ireland may be represented through this. And so, as you can see, the entire European Union is probably well represented within the Basel Committee. On the other hand, you have the US, which has 4 voting members for the 4 agencies. And they're much more homogeneous in their voting behavior, and they tend to operate like a team very much, whereas Europe is more or less, a group of coalitions, and they don't always agree. So the US is a power block, and then the other big player is China together with Hong Kong, but they're pretty new, and I'm not sure over the last 10 years how they are behaving. But mind you, a lot of the action happened.
I cannot resist interrupting you on this because it's not really our topic, but I'm very curious. Can the US for participants vote differently? Is it possible that, say, the FDIC votes on one direction and the New York Fed votes in a different direction, or is that impossible given how it's organized?
I'm not so sure, but my experience is that they group together at meetings and quite often have to refer back to Washington before they decide on a vote. So that's kind of frustrating because if you're in a meeting.
I'm sorry, I don't want to interrupt. I don't know, it's not allowed, but as a long-standing member of the Basel Committee, I can say yes, it happened. It happened that sometimes they don't vote the same way and that they disagree. I mean, it can happen.
Very interesting. Yeah. I close the parenthesis because this is a digression, but very interesting. Thank you both.
So it's more or less the United States versus Europe as a big bloc and kind of disunited in some way, shape, or form. But these are the big drivers, I think, within the committee. So having said that, let's look at what Europe is doing. So here again, so what Europe is doing, Europe is playing on various fields very actively and very assertively. So one is the disclosures. The EBA has released a technical standard called the Pillar 3 ESG implemented technical standard. I'm not going to talk you through that, but it requires banks to publish on transition risk and physical risk and also mitigating measures. It will present, or it will require banks to present the green asset ratio and the BTAR, which is kind of similar to the green asset ratio, and which kind of shows the extent to which banks are compliant with the taxonomy, which is also a big thing within Europe. And so banks have to disclose a lot, and there are special templates for that, and investors will learn from that, and hopefully through the market discipline, things will improve for banks and for the environment as well. Then on the other hand, there's the ECB, which is also very ambitious. They have big plans. They have set out their expectations in a report called the Guide on Climate-Related Environmental Risk in 2020, and they're just policing that very heavily. There's a couple of lines here, but it boils down that the ECB is very adamant in making sure that banks meet these requirements. So, if you look at point 3, by the end of 24, banks are expected, so this by the end of this year, banks have to meet all the supervisory expectations, and there are about 13 of them on climate and environmental risk outlined in 2020, including full integration of the internal capital adequacy assessment process and stress testing. So, and then last January, they decided to even broaden their remit and step up their efforts in this space. I think now it will include also biodiversity risk. That's big. And then the ECB also does stress testing. And the stress test results will, at some point, will feed into Pillar 2 requirements. So again, here, Pillar 2 is kind of the soft, but hard at the same time. Pillar requirements on capital that are agreed between the ECB in the so-called SREP letter with the banks. So you can see that there's capital consequence already here through the stress test and the Pillar 2 requirements. Also, the ECB is not very afraid of using the stick. They're threatening with penalties, and they have threatened some banks in Europe with Pillar 2 add-ons because they were not sufficiently complying with the expectations. So that's pretty heavy-handed work from the ECB. So that's on the one extreme. And now moving to the West, we see that things are cooling down a bit. If you look at the Bank of England, Sam Wood said, we find regulatory capital is not the right tool to address causes of climate change. So he takes a very traditional approach here by saying, well, actually, whatever risk you can identify as part of your normal banking operations, you have to deal with them in a sort of like a traditional way, not much more than that. And on Pillar 2, that covers the other risks and the additional risks that are not covered on Pillar 1. It says, currently firms should capture material climate related financial risk as if they are exposed to these risks and they are not fully captured by Pillar 1. So this is kind of a very traditional approach to Pillar 1 and Pillar 2. Yeah, so that's a step down. And then if you go to the US, it's even more quiet or more traditional. If you look at what the Fed says, first of all, the Fed joined very late the NGFS, the Network for Central Banks and Supervisors for Greening and Financial Systems. That NGFS started in 2017 with a couple of European joining members, including I think even Mexico, but I'm not sure. But they started quite early, but the US chipped in 2020, which is late. And then thanks to, I think, Lyle Bernard and Kevin Stira, some action was initiated with respect to climate risk. But if you look at the recent statement from Jerome Powell, he says, you know, the Federal Reserve is not and will not be a climate policymaker. It's not the Fed's role to tell banks which business they can and cannot do. Again, here, very traditional. They are acting in the interest of financial stability, and that's what they do, which is also confirmed by Michael Barr's statement of, what is it, late 2022. He says, you know, our mandate is important but narrow, and we are focused on our supervisory responsibilities in our role in promoting safe and stable financial systems. So that's a very traditional role. And you can guess probably where that pressure to be very conservative comes from, but I'm not going to talk about that at this moment now. But they're very conservative and so forth. So between these extremes, there's a lot of other countries. They all chip in, they all contribute, they all do something. Most of the action takes place with respect to Pillar 3 and disclosures. Then there is plans then there are initiatives with respect to transition plans. But you can see that most of the action is about disclosure still. Then moving back to the Basel Committee is, you know, what are they doing? As they are also pretty conservative and not fast moving. One thing that I would highlight is to highlight the difference between, you know, or the tension within the Basel Committee is this one here. Quite often before a Basel Committee meeting, there's the meeting of the governors and heads of state, which then issues a press release. And one thing that I found...
Governors and heads of supervision, I have to be purist here.
Oh, head of supervision. Did I make a mistake there? Sorry. So so these are the heads of supervision and governors. Yeah, okay, sorry. So what they said, they issued a press release where they explained to the Basel Committee what was expected from the committee. And so on climate, they said, you know, you have to take a holistic approach. Fair enough, that is kind of more or less wait and see. And I think within the context is probably the right thing to do. But on crypto assets, they had a much more assertive stance here on crypto. They said the GEOS asked the committee with respect to finalizing such a framework around the end of the year. So that's the end of 2022. So within weeks, it was more or less expected that the committee would deliver on crypto, whereas for climate, the approach was holistic. So that's different. And you can see that in many things as well, that the Basel Committee is just, you know, not at the leading edge or the cutting edge of regulation here, probably because of the US and other countries that moderate the pace a bit. Again, here in later statements, they re-emphasize this holistic approach. And also, and I think that's a fair point, the first bullet says there's a high degree of uncertainty around the timing and of physical and transition risk. So there's problems with gathering the correct data, and without data you can do a lot, and I think that is reflected in this first bullet point. And so I can see why the Basel Committee is a bit hesitant here and moves as it does. That's just a tour de table of what I see in the rest of the world. A couple of my observation is that, again, here there's a strong focus on using Pillar 2 and Pillar 3, disclosures and the supervisory review process. Pillar 1 is still untouchable, although recent developments within the European Central Bank sort of seem to indicate that they're making a move forward with respect to integrating policies in Pillar 1. especially after the alignment document of a couple of weeks ago. The other thing that I noticed is that the ECB is taking a very sometimes overzealous approach. One thing that they did is they reinterpreted their mandate from the TFU, which is the what is it, the functioning of the European Union. Yeah, exactly. So the primary, this Article 127.1, I think, and the primary objective of the ECB shall be to maintain price stability. That's, you know, that's the prime mandate. And then there is this second mandate or secondary mandate where which is then interpreted in favor of integrating climate policies within the mandate of the European Central Bank. I think it's kind of audacious, and yes, you know, it worked well for climate because climate, you know, Europe signed up with the Paris Agreement, and that's part of the policies of the Union. And so, given that, you know, this is all European policies, the ECB will support that. And so, this is kind of a way of shoeing that in. So yes, they do that, and there may be, you know, I was just looking at Twitter, and there's discussion about this, the interpretation of the first and the secondary mandate. Currently, the ECB is also prompting, or, you know, telling the story that climate change will increase prices and will affect price stability. So they're moving climate towards the first objective and leaving the second a bit, you know, more having the second mandate a bit less emphasized. Other things that I noticed that, you know, the European Central Bank sometimes, you know, pushes the evidence a bit. Like, for example, in the 22 stress test, they said, well, they projected a loss of 70 billion losses, aggregate losses for the banks that they had included in the stress test. So 70 billion is not trivial. I mean, it's a lot. But then if you compare it to the total asset side of European banks, is about 25 trillion euros, and then the 70 billion becomes kind of like, not so big. So yeah, that's kind of a matter of emphasis. And the last one is the graph here. This is a graph that shows vulnerabilities of Europe, and the blue part is flooding risk. And so what you notice here in the middle of this picture, you can see that the heart of Holland, like Amsterdam, Rotterdam, Utrecht, they will suffer, or they are exposed to flooding risk. And so, yes, yeah, that's true, but we've been managing that as Dutch people for the last 500 years, I think. And so, yeah, so this is kind of tricky evidence, because the Dutch know how to deal with water, and so do many other countries. But given that it's based on satellite data, it looks like, oh, there's parts of Holland that are very lying very low, and so therefore you would expect there's flooding risk. But it's well managed. So this kind of information is kind of like, yeah, well, pushing it, I think. But, you know, there isn't a clear ambition from the ECB. One thing that I want to emphasize here is that there's a lot of stuff with respect to the pillars, pillar 1, 2, and 3, and people are waiting for the moment that pillar 1 becomes the main tool here. But the other thing is that stranded assets at some point, or all these climate risks will at some point affect the bottom line of banks, and that will affect their profitability, and that feeds directly into capital. And so the accounting standards may play an important role in advancing the interest of climate risk or climate change, in that the accounting will pick up these risks and feed them directly through into capital. So that happened to Rabobank. Rabobank was suffered from that a couple of years ago. They noticed that given the nitrogen policies of the Dutch government, they suddenly couldn't vouch for the value of their assets that they had. You know, Rabobank is a large agri-lender, and so they had to take a loss on that one. And so I think that's kind of cool, because again, this podcast or this video is about financial statements, and this is sometimes forgotten that the IFRS can be an important player in helping banks to mitigate climate change. And so with that, I leave it, and I'm happy to open up for discussion if you're fine with that, Nicolas.
Fantastic. Sylvie.
Thank you very much, and thank you very much also for having me here today. First of all, thank you, Martin, for those slides and for highlighting the situation regarding banking regulation and climate risk. I must say that I was particularly interested by the discussion of the Basel Committee, having been a member for more than 10 years of that institution, so I can speak for hours on the way it behaves, so maybe it will come back in the discussion. Regarding banking regulation and climate risk, I would like to focus my remark on 3 points, drawing on my experience both as a former regulator and as a banker. The first thing would be what regulation should do in that respect, what regulation could do, and what regulation should not do. Climate risk is a very specific risk, and that's why it's quite difficult to tackle it, because it's more longer-term risk than what banks used to have traditionally on their balance sheet. So what banking regulation should do in that respect is, first of all, increase awareness. That's very important. Second, make sure to be very clear about the disclosure it's going to be requested. And that's very important because from the bank perspective, you need to be able to manage and to deliver those disclosures in order to enhance the transparency, to inform investors. And it's not something easy. For example, climate risk data more of the time are with the clients of banks. So in fact, if you ask banks to disclose some issues, they need first to make sure that they have those information and that they can ask those information from their clients. So manage the adequate data is something very, very complicated, and no bank can do that if the disclosure requested are not clear. So be clear about disclosure, and the Pillar 3 Martin was referring to is very, very important. Another thing that regulation should do is also to be very clear about the expectation in terms of governance of those risks, risk assessment, and banks on their side should make clear that in fact they look at those risks as well, even if it's more longer term than traditional risk. They integrate that in their risk assessment, in their risk appetite. They also integrate that in their internal stress testing, and that's something that the ECB is very keen about. So that's about what the regulation should do. Then the regulation could also, and we are in the second point, what regulation could do. They could integrate climate risk in their capital framework. And Martien was referring to that by referring to the Basel framework with its Pillar 2, Pillar 3, and Pillar 1. So Pillar 3, I think that's done. The Basel Committee is currently having a consultation on disclosure. So Pillar 3, information to the market, that's going to be very clear recently that all banks that follow the Basel rules should be completely aware of what type of data they will need to provide to the market and at which frequency. And that's a good thing, because if it's endorsed by the Basel Committee, it will be harmonized across G20 countries. So Pillar 3 is done. Pillar 2, and Martien referred very clearly and rightly so to the fact that the ECB is at the forefront of this battle. And the ECB is currently looking at those climate risks, both physical and transition, within the SREP assessment. And in fact, it can conclude in sometimes a Pillar 2 requirement or add-on, as mentioned, as Martien mentioned it. So in fact, I guess, at least in Europe, Pillar 2 is already included, climate risks are already included in that Pillar 2. However, Pillar 1, which would be something, a step forward, is not something that is currently envisaged at this stage. Although I understand that the ECB is really very active on this front, but honestly, I don't see it coming soon. One of the reasons is that the time horizon is completely different from traditional risk that the Pillar 1 of Basel framework is taking into account. Usually it takes into account risk for the next year. And in fact, climate risks are longer term. So the time horizon is different, and it's difficult to integrate into the traditional Pillar 1. So that's what regulation could do. And then we come with the last point, which is what regulation should not do. And in fact, it should not tell banks what they need to do. I mean, the job of banks to know exactly what type of lending, what type of business model they want to pursue. I mean, of course, they need to make sure that they can pursue this type of business model, meaning that they do have a good risk management, they have a good understanding of their risk, and also they put enough protection in terms of provision or capital against those risks. But it's not up to a regulator to say, you should not lend to this type of to this category of people or to this type of products, because it's I mean, it's really up to the banks to decide. So that's why when I read like a lot of people when the ECB was speaking of fines, I mean, it's not about putting additional capital, because banks would not have been enough serious in terms of protection of the risk. But it's really fine because it was not fulfilling expectation. I mean, for me, that goes a little too far. And I understand that the ECB is a little alone in that type of direction. But honestly, I think rightly so, because it's something that, and Jay Powell, in one of the quotes that was in Martien's slides, clearly said it's not up to the regulator to tell banks what to do and what not to do. And there is a last thing that regulation should not do, is to put banks, a category of banks, at disadvantage. And it's very clear in the slide that have just been presented that Europe is much more advanced than the other countries, and that the US, and not to speak of the rest of the world, are less advanced in terms of how, if and how to integrate climate risk into banks' regulation. So in fact, if you put too much pressure on European banks to take that into account, to put additional capital, not even speaking of fines, then you run the risk as a regulator to put European banks at disadvantage, competitive disadvantage towards the others. And also, you must not forget that when you looked at the climate risk and green financing, I mean, green doesn't mean the same thing in every place of the world. I mean, something that can be looked as brown in some countries of continental Europe, for example, can be looked as green in other parts of the world, because what is important is the transition. What is your starting point? And in some place of the world, for example, if you take Africa, if you move from coal to another type of energy, it can be an improvement. While in another country, if their starting point is different, then it's not an improvement. So you need to be careful not to have a static approach, and that's something banks need to envisage when they do their lending policy. So I hope I stick into the 5 minutes you allowed me to.
Yeah, indeed. Thank you very much to both. I'm always an acronym person here, so there was reference to the SREP, that's the Supervisory Review and Evaluation Process in the European Union, functionally equivalent to the CAMELS rating process in the US, long story short. And of course, there were a number of references, including in embedded links in Martin's slides. The slides are or will be soon available on PIIE.com, as usual in this series. Now, we already have a few questions, and I encourage the participants on Zoom to use the Q&A tool. But there's something of a clarification question from Charles Cannon, maybe to you, Martin. In comparing the UK with the Eurozone, the UK's authorities have an approach for Pillar 2 that is about looking at environmental climate risk for the bank as opposed to the footprint of the bank. Isn't that pretty much the same between the UK Prudential Regulatory Authority and the European Central Bank?
Yeah, I mean, it's a gradual difference, I think, between both. Pillar 2, what I recollect from the Bank of England is they want banks to look at least 5 years ahead. And then observe the risks that will materialize within a 5-year period and integrate them in their Pillar 2 PRA buffers. Whether that's footprint or not, I don't think so. And likewise for what Sylvie just said about the ECB, when they write the SREP letter, they integrate these risks as well. So it's kind of, I think the differences are kind of gradual and not too far out. It's more that I think the ECB makes is much more vocal about it. And but yeah, the other thing that I was commenting back to Sylvie is that if you go through these supervisory expectations of the ECB, they're pretty they're pretty much about processes, identifying risk, risk management, and disclosures. And if you look at recent statements, I think from the ESRB also, they don't want to tell banks to say emphasize green at the expense of brown. because that is, I think, not how things will work in practice. So the ECB is, in the execution of their policies with respect to capital, are pretty much focused on everything about everything that has to do with risk management and disclosures, and not so much about activities.
And you mentioned ESRBs. The ESRBs, of course, the European Systemic Risk Board. Sylvie.
Oh yeah.
No, that's, I mean, everything that is related to risk management and how to integrate that into your risk assessment, risk appetite, that's all fine, because in fact, banks should do that with every risk. But I mean, when you speak about fine, it's not capital charge. I mean, that's something different. And that, I think, is a little too far.
Oh, yeah. And yeah, that's the one, I think.
Back to the Basel Committee. We had a session with Neil Esho, the Secretary General of the Basel Committee in late January. He was very cursory on these issues of climate-related concerns, because he put most of the emphasis on Basel III in the last chapter. But Sylvie made a sweeping statement saying that Pillar 3 is basically done. Do you agree, Martin, or is it more complicated?
Well, from a European point of view, they're pretty much out there. I think that's without question, with their with the ITS on ESG, lots of acronyms with the Implementing Technical Standard on Environmental Sustainability and Governance Risk. That's part of CRR, so that's the Capital Requirements Regulation. So that's pretty much hard-coded, and also intensive in terms of the requirements that are imposed on banks to gather all the information. The consultation document of the Basel Committee, my impression is that it borrows from the efforts from Europe here, and so they're following Europe more than that they're leading. So it depends on where you are, whether you can say it's done or not done. So yeah, Europe is out there, and the rest is just following, I think.
Yeah, sorry, go ahead.
Yeah, the question is, what more do you want? I mean, it's pretty intensive, and so what Europe has done is kind of big. So what more do you expect?
No,
the question was more at the Basel Committee level. So basically, do you agree that the Basel Committee has done what they have to do in terms of Pillar 3, and that any further debate would be on Pillar 2?
Well, I guess it's, I mean, to be honest, I would agree with Martin that what is required in terms of volume of data and distinction of criteria, I mean, it's really big. It's really very important. And what is important also is that it can be more harmonized across countries. So that's why the fact that the Basel Committee is following on this is really a good, I mean, in a way, it's a good news, because at least it will be harmonized and it will be spread across the G20. Yeah. Now, I mean, I don't think that you don't need to have, I mean, you don't need to have a lot of information. You need to have the good information. And I remember when I was a banker and there was a lot of requirement about information. I mean, I was not worrying about, I mean, there is one point to be worried about is, are you able to give those information? Are you able to have those information internally? But then if you give more information, you run the risk of missing the good one. So in fact, I guess there is a lot of requirement in terms of disclosure. I'm not completely sure that it gives investors and the market at large the good information they should look at. So in fact, we need a little more maturity about that. I mean, at the beginning, the request is very large because, I mean, nobody knows exactly what would be the most meaningful information, and it depends the type of lending, to be honest. But then when it will be more mature, I guess the market will focus on the more meaningful information, and that will be a progress.
And they will be learning by doing. There's a question from Julia Bingler from the Council on Economic Policies in Switzerland to you, Martin, on whether you're a bit stark on the Basel Committee, saying they are hesitant on climate. So if I understand Julia's question correctly, she says they are pretty clearly directions from the Basel Committee, including in its updated standards for Pillar 1 from January 23, that climate risk needs to be taken into account. They issued a consultation on the core principles, which is quite outspoken about climate and other emerging risks. Still quoting Julia Bingler's question, would you agree that based on the wording available now, it is more the task of supervisors in individual jurisdictions in their move towards Basel III issue additional guidelines on how the risk-weighted asset calculation should take climate risk drivers into account, as opposed, I guess, to further work by the Basel Committee? Can you expand on that?
Okay, so a lot of stuff to unpack there. I think actually the Basel Committee in how it moves and how it decides is it's not hesitant or so, but probably very cautious. And I think one of the reasons why they do that is because of the data required to meet expectations. I mean, you can require something from banks, but the data has to be there, and data has been a problem. And so that is, I think, holding back the progress a bit. So I wouldn't say that is reluctance or so. It's more that my feel is that the Basel Committee is just moving very carefully here, and I think for good reasons, because it's unknown territory. It's a global regulator. It has global responsibilities, and it also serves countries that are not as like Europe. So yes, Europe can do its own thing. But it doesn't mean that everybody has to do exactly what Europe does. So no comments on the Basel Committee per se in a negative way. So the second part was what? Can you say that again about moving towards the banks or the central banks themselves?
Would you agree that based on the wording available now, I mean, it's what you said basically. It was specifically on risk-weighted asset calculations, whether it's not more the task of supervisors to issue additional guidelines on how to take climate risk into account.
Yeah, that's what we see in New Zealand happening, where the supervisor does its own thing. I prefer, given that banking is a global industry, I prefer to have things harmonized in a good way.
Right.
Yeah. So yeah, experience with New Zealand so far that they are very heavy-handed and sometimes an outlier as a result.
More heavy-handed than the ECB?
With respect to capital, yeah, they doubled, I think, the amount of capital requirement in a very short time. So they're close to Iceland, I think, now, which is pretty steep.
I was also asking a question to you, Sylvie, about the European Banking Authority, and they have a recent consultation paper. So the question of whether they are solving the issue you mentioned with the 1-year time horizon for the risk-weighted asset calculation. They require integration, still quoting Julia Bingler, for short, medium, and long-term risk assessments with minimum 10 years time frame, and the insight from these assessments need to be taken into account for the internal models and any other credit risk assessment. So I don't know anything about this consultation of the European Banking Authority, but presumably you do.
Yes. It is currently, they are consulting in terms of guidelines, and they do have both quantitative and qualitative guidelines. And the discussion about the time horizon have been very active, because a lot of people say, well, it doesn't make sense to put capital against climate risk. Some of them will materialize in more than 10 years. So in fact, all regulators try to find a way to integrate that in a more meaningful way, short term. And for example, the European stress test, which was done, climate stress test, which was done in 2022, had a time horizon of 3 years. So in fact, that's why these guidelines also try to make sure that they can put it in a time horizon that is meaningful. And don't forget that you can't put capital on something that is too much longer term. So in fact, if banks manage to give data according to a shorter time horizon, that might be a first step to be able to provide capital charge against too much risk or too large exposures, for example. And coming back to the question of Basel, I guess that Basel is maybe can be seen as less active or less at the forefront than the Europe, I mean, because of its members. I mean, clearly you do have the Europe that is pushing towards that, but you have other, I mean, on the I mean, enlarged. It has been enlarged during the great financial crisis at the G20, and so now you have 27 countries. Never understood why G20 27, but anyway. And so you have around the table not only Europe, but the US, but also China, also India, which may not be so keen to be on the forefront on climate risk, to be honest. So that's why they need to find the right balance. And I think disclosure, it's a first step, which is interesting to go forward.
Martin, on this, there's also a question in the box about that. Can you expand a little bit about all these other jurisdictions, South Africa, China, Singapore, Brazil, whoever else? I mean, we know that some of those jurisdictions, for example, China, are doing a lot in terms of climate change policy, but does it do anything of it through the banking sector?
So yeah, I had a brief look at that. Sorry, my time to prepare for all that was kind of short. But in the list that I just showed in the table, it shows that banks' disclosures are definitely well covered within China, but the other jurisdictions mentioned are I've got that. So my guess is that given that many banks worldwide have signed up to the zero in 2050, my guess is that they will have support net zero. Yeah, so they signed up for TCFD, and they participate in these fora. So my guess is that the central banks will just follow more or less the basic minimum requirements there.
Essentially, all the impetus is coming from Europe, right? There is no other, even Singapore, there's no other activists elsewhere in the world in this space.
Well, there's funny though. There is a website that measures the extent to which central banks are adhering to or are advancing climate policies, and it's remarkable that some countries are at the top. I think France is at the top. Vive la France, and but other countries are down, and China is remarkably high in that list. So they're, I think, number 10 or so. So I forgot the website, but it's interesting to see an entire website dedicated to scoring countries on their climate policies with respect to banks. And it's remarkable. The US is pretty much not the most, it doesn't have the highest score, but there's still some European countries that don't score high either. So yeah, there's probably still some heterogeneity before everything starts converging.
But in the Eurozone, in any case, these policies are not set at the national level anymore. So there's only so much that a national central bank in the Eurozone can do to improve or decrease their score, I guess, depending on the methodology.
Yeah. There's a couple of things that, so it's great that Europe does this, but on the other hand, I think Jérôme Legrand, he mentioned in the the Financial Times a couple of years ago that the banks should not be operating on behalf of governments, and so there is a bit of that, like to extend our banks here being used to implement policies that governments should be doing, and so and in that case, I think Europe is advanced because it has a central bank that pushes hard. But other countries may have a more hands-off approach to that and say, well, central banking is part of the central bank, but their remit may be more focused.
Jérôme Legras being another of the members of the Global Brotherhood of Capital Nerds, and also a recent guest in the series. On the rest of the world, Sylvie, is there anything you would like to add?
On what, sorry?
On kind of this rest of the world perspective, emerging markets, China.
That's absolutely right, that Europe is really, really much more advanced than the other. I would also completely agree that, in fact, it's not up to banks to go into political debate. And that's why, in fact, the banking regulators are really keen to make sure that, in fact, they focus on risk, and they highlight the fact that climate change is a risk for banks, either physical, related to their mortgage portfolio, for example, or either transition, because they need to help the transition. So, in fact, they should focus on this risk angle, because that's the way they should tackle that within the banking industry. No other way.
So we have a question from Patrick Honohan about the cost-benefit analysis of all this in a way. And Patrick suggests that, both of you have hinted at the fact that the ECB may be pushing too hard, but at the same time, the risks are vague and potentially large. So if there is a moderate cost of extra regulation, it may be justified. This is a bit going into, theory of regulation. But I'd be interested in both your views about that. Isn't it a cost worth having given the uncertainties?
Well, from a global perspective and a strategic macro level, yes. But when you are a bank, it's it's really costly to make sure that you have all the information that is requested. Don't underestimate the cost of data collection, because in fact, when you make a loan, take one individual loan, if you don't know at the start which information you will need in the future, and if you don't make sure that you flag that information from the beginning into your own IT system and data lake, in fact, if you have to look at it later, it's nearly impossible to find back the information. Or if you need absolutely to do that because the regulators insist that you do it, and it costs a fortune because it has a lot of IT implication and it's really very complicated. So don't underestimate the individual cost as individual bank level. That's true that if you look at it from a strategic macro policy, absolutely that's what should be done. And it's very good that Europe is leading the way. But if you are a bank, you need to manage your earnings. You need to answer your shareholders. You need to make sure that you have a good return. And honestly, it's not your job to make sure that, you do public goods, more or less. Huh?
Well, that's why we have regulation, I guess, because there are misalignments of incentives.
Yeah,
Martien,
exactly.
How do you think about Patrick's question?
Sorry.
Basically, straight up, given the uncertainties about climate change and, it's accelerating and it's not happening the way we thought it would be, isn't it worth over-investing into the regulatory effort because the risks are potentially so big and also vague? I think I'm conveying Patrick's question more or less as he intended.
Yes and no. If it wasn't for the hard pushing of the European Central Bank and the push for data in particular, then we would never have the data that we need to figure out climate change, and so we never will solve the uncertainty. So it's a double-edged sword here. If you keep to the very traditional method, like if you look at the Fed, they say, well, we'll be very conservative. But the thing is, if you do that, you will never probably solve the uncertainty because you don't have the high data requirements that are now required for having climate policies in Europe. So one of the things that came out from the ECB a couple of weeks ago was this alignment report where they showed that so many banks were misaligned. And if you look at the data exercise and the methodology there, it's pretty well advanced in the way that they now are able to figure out at high levels of, at a very detailed level, the risks. 10 years ago, that would be impossible, but today with modern technology, they can figure out that risk. So that's just very close to moving with that data and the high quality of the data. It's very we're on the verge of getting into Pillar 1 territory, because with very excellent and high quality data, it's much easier to move towards Pillar 1. So yes, it's heavy-handed, and I think banks will struggle with the data system and implementation. That's always a costly exercise, and it may have effects on competition between banks, between blocks. Like other countries may be cheaper off of banking, and other countries may be cheaper off. But the advantage of what the ECB does is that they're pushing this so hard that it leads to technological innovation, and that innovation will probably help us.
There's a comment by Julia Bengler, again from Council on Economic Policies in Switzerland, saying that Singapore is also quite advanced and moving pretty close to Pillar 2 on these issues.
True, and again, here I encourage people to look at, I forgot the link, but there is the website that ranks countries, and again, there's surprises there.
I haven't checked.
There's something green banking finance or sort of website.
Pretty basic question, but goes to the core of the issue from Francis Schwarzkopf. Maybe to you, Martien, first. Should banks face higher capital requirements for exposures to fossil fuel companies that are expanding production, given the risk of stranded assets? Yes, no?
Yeah, you could think of that. For example, requiring, having higher risk weights attached to that can be done. The thing is, brown technology is kind of safe and without risk, and then green technology is much more risky, and so that may lead to confusion in the sense that you are rewarding banks for investing in very risky industries, whereas you're penalizing them for investing in very safe industries, and so that may backfire, I think, and that explains also why what I said, the ESRB and other and also the ECB is not focusing on industries and activities, but much more on risk management, identification, disclosure, and various Pillar 2 add-ons based on risk identification.
You're involved with a number of banks right now. CCF is a local domestic French bank. Edmond de Rothschild is more of an asset manager, but it's very close to the banking space. Can you give us more of a sense as a practitioner of how you see the banks evolving here, building systems, investing, whether there are any, sunk costs, things that they have invested in that turn out being completely useless? I mean, give us perhaps more of a sense of the concrete experience?
Well, in fact, they do invest and they will invest. First of all, in terms of data collection, data lake, being able to provide information in a more agile way. So yes, indeed, they have invested and they will invest. It's also, I guess there is a good thing that in a way that they began to understand better their own portfolio. I mean, and whether the client base has an impact regarding to climate change or not. So certainly that it will continue. Now, whether they're willing to have additional capital charge against that, I mean, of course, banks never like capital charge, but I guess if you come back to your earlier question, you need to go back to the basic of capital charge. Capital charge is there to compensate for risk that are not well taken care of by banks themselves. So they need to put capital against it. And the risk of climate is not to think about what is good or, I mean, even if that seems strange and maybe it's not the right way to do that, but from a banker perspective, you don't look at it whether it's good or bad for the planet, whether you have a risk for yourself as a bank. So if you invest in if you do have a portfolio that is really focused on brown activity, is it a risk for you as a banker? Are you going to lose money because of that? And in fact, if you say that today the investors are much more acute to that type of risk, and if you run the risk that people, because there will be a lot of negative publicity if you land to such type of category of industry, and that people may vote with their feet in a way that they will not like to do work with your bank anymore, that's a risk. And that's why you could envisage to have more capital if you're too much exposed to brown type of activity, just because you are at risk as a bank to lose clients, to lose depositors, even to lose your own people. Because in fact, when you work in a bank, I mean, the more and more, especially the young generation, is much willing, doesn't want to work for a bank that is investing in that type of activity. So in that respect, because it is a risk for the bank, yes, it can be a reason to have higher capital charge. So, and I would prefer, as a former regulator, to have a higher capital charge because of that, rather to have incentives for green, because I guess that's not the spirit of the banking regulation.
We're at the hour. Thank you so much. Thank you, Sylvie Matherat, for illuminating comments, including these concluding words. Especially thanks to Martien Lubberink for making himself available at the exact wrong time of the day. We're very grateful for that. It's great to have you. We'll have the next session of this series on Tuesday, 12th of March. We'll discuss liquidity provision in the US and debates about how to make it better with Andrew Metrick from Yale University, recently also at the US Treasury. In the meantime, again, many, many thanks to our two speakers, and have a great rest of your day, or if you're in New Zealand, of your night.
Thank you. Bye-bye.
Yep. Thank you. It was a pleasure to join in this discussion. So you're welcome.
Bye.
Thanks so much.
You.